When everyone agrees on the value of an investment, that is precisely the moment to be careful. There's an old Nordic concept, the law of Janti. It describes the group pressure to conform, to not stand out, to not think you're better than anyone else. In the world of finance, this instinct can be your worst enemy. It's the quiet voice that tells you to follow the crowd, even when the crowd is running towards a cliff. This is the story of that voice, of collective belief, and of the moments when reason is drowned out by the roar of the machine. Warren Buffett famously called Bitcoin rat poison squared. His partner, Charlie Munger, was even more direct, describing it as a venereal disease. These are not men known for reckless statements. They are titans of investment, architects of fortunes built on value, patience, and a deep-seated skepticism of anything that promises easy wealth. Yet, as their words of warning echoed, the charts told a different story. Bitcoin, a digital curiosity, began a meteoric rise, followed by thousands of other cryptocurrencies. It was a financial revolution, we were told, a paradigm shift, and for a moment, it seemed the old guard simply didn't get it. The skepticism of the world's most successful investors was pitted against a tidal wave of public enthusiasm. The question wasn't just about who was right, but whether the old rules of finance still applied. It's 2 a.m. The world is asleep, but you're awake, bathed in the glow of a screen. A chart flickers, its green line climbing relentlessly upwards. You trace it back with your finger. 2016. What if I had just put in a little then? $1,000 in Bitcoin back then would be, you do the math. Then you check Ethereum. The number is even more staggering. It's a dizzying cocktail of regret and longing. This feeling, this fear of missing out, isn't just a modern phenomenon. It's a primal human instinct. Our ancestors survived by sticking with the tribe. Being left behind meant danger. Today, that same instinct drives us to chase assets we don't understand, simply because everyone else seems to be getting rich from them. It has the fear of being the only one left on the platform as the train to prosperity pulls away. Even the greatest minds are not immune. Sir Isaac Newton, the man who formulated the laws of motion and universal gravitation, a titan of logic and reason, fell victim to the madness of crowds. In the early 18th century, Britain was gripped by the South Sea bubble. Shares in the South Sea Company, which had a monopoly on trade with South America, soared to astronomical heights based on fantastical promises of wealth. Newton invested early and made a handsome profit. He sold his shares, content with his gains. But as he watched his friends and peers continue to make fortunes, the pull was too strong. He jumped back in, investing a much larger sum at the very peak of the market. The bubble inevitably burst, and Newton lost a fortune, an amount equivalent to millions today. He later lamented, "I can calculate the motion of heavenly bodies, but not the madness of people." His story is a timeless warning. Intellect is no shield against the powerful allure of collective euphoria. Imagine you're in a room with a group of people. Slowly, a wisp of smoke begins to seep in from under the door. You notice it, but no one else says a word. They continue their conversations. The smoke gets thicker. It stings your eyes. Still, silence. Do you raise the alarm and risk looking foolish, or do you stay quiet, assuming the others must know something you don't? This was a real social experiment conducted in the 1960s. It demonstrated a powerful principle. Our perception of reality can be warped by the inaction of those around us. In a group that ignores a clear danger, an individual is overwhelmingly likely to ignore it too. In financial markets, the smoke is the speculative frenzy, the detachment of price from any real value. The crowd ignores it, and so we seat, pretending not to see the room fill with smoke, convincing ourselves that everything is fine. This pattern is not new. It repeats throughout history with eerie regularity. In the 17th century Holland, it was tulip mania, where single tulip bulbs were traded for the price of mansions before the market collapsed into ruin. In the 1840s, Britain was consumed by railway mania. Speculation on new railway lines drove share prices to absurd levels, fueled by the promise of a new technology that would change the world. It did, but not before countless investors were wiped out. Then came the roaring 20s in America, A decade of prosperity and excess that ended abruptly with the great crash of 1929. And in our own recent memory, the dot-com bubble of the late 1990s. The internet was a revolutionary technology, but the belief that any company with "com" in its name was destined for infinite growth led to a spectacular crash. The details changed tulips, railways, websites, cryptocurrencies, but the story remains the same. A groundbreaking innovation sparks genuine excitement. That excitement bleeds into speculation. Speculation blossoms into euphoria, where prices detach from reality. And then, the inevitable collapse. It's like the old folk tale. The emperor's new clothes. Two swindlers convince an emperor they can weave him a magnificent suit of clothes that is invisible to anyone who is stupid or unfit for their office. Of course, there are no clothes, but no one, not the emperor, not his ministers, and not the crowds lining the streets, dares to admit they can't see anything for fear of being judged. Everyone pretends. Everyone praises the beautiful, non-existent fabric. They participate in the collective delusion because the social costs of telling the truth feels too high. They praise the emperor's new assets. They comment on the strong fundamentals of his invisible portfolio. It takes the honesty of a small child to finally shout, but he isn't wearing anything at all. In every financial bubble, there are countless people who see that the emperor is naked, but they remain silent, caught in the powerful consensus of the crowd. There is a simple, yet powerful, metric for gauging the temperature of the market. It's often called a buffet indicator. It compares the total value of all stocks in a country, the market capitalization, 2D country. Total economic output, its GDP. Historically, a ratio around 100% is considered fairly valued. Let's look at the peaks of past bubbles. Just before the great crash of 1929, the indicator hit a den record high. At the peak of the dot-com bubble in 2000, it surged to an unprecedented 141%. Before the financial crisis of 2007, it was elevated again. Now, let's look at today. In late 2023, the U.S. market cap to GDP ratio stood at a staggering 226%. This isn't a prediction. It's a data point. It is a measure of how much the perceived value of financial assets has detached from the underlying economy that is supposed to support them. The number is stark, objective, and historically, it has been a reliable, if early, warning sign. The market is more expensive relative to the real economy than it has ever been, including at the top of the two most infamous bubbles of the last century. And system. The narrative is particularly compelling. We have not what but two revolutionary technologies capturing the public imagination: artificial intelligence and cryptocurrency. The story is powerful. AI promises to reshape every industry, and NVIDIA, the company making the chips that power this revolution, has seen its stock price climb to astonishing heights. At the same time, Bitcoin has re-emerged, hitting new all-time highs, championed as a digital store of value, an inflation hedge, the future of finance. It's crucial to separate the technology from the valuation. The internet was real and transformative, but most dot-com stocks went to zero. AI is undoubtedly a powerful force for change, but that doesn't automatically justify any price for the stocks associated with it. Technology can be real, and prices can still be profoundly wrong. The excitement around a genuine innovation can become the very fuel for a speculative bubble. Every bubble ends the same way. The music eventually stops. The euphoria gives way to anxiety, and then to panic. It doesn't take much. A slight rise in interest rates, a disappointing earnings report, a slowing economy. Suddenly, the assumptions that held the entire structure up begin to crumble. The belief in ever-rising prices shatters. Those who bought at the top, driven by the fear of missing out, are now driven by the fear of losing everything. They rush to sell, but the buyers have vanished. The smooth, upward climb becomes a terrifying, vertical drop. The smoke that everyone was ignoring suddenly becomes a raging fire, and the exits are too small. We see the signs of a slowing economy now in weakening consumer demand, in vacant office buildings, in the quiet strain on household budgets. The foundations are trembling. We are left with a simple question, one that every investor must ask themselves in the quiet moments, away from the noise of the crowd and the allure of the charts. Are you thinking clearly, or are you just afraid of missing out?